So in this video we'll talk about Adcore, which, as you know, is a position of mine. Adcore is listed on the TSX Venture ticker ADCO and on the OTC ticker ADCOF, okay? And today we'll compare Adcore's valuation to the valuation of other companies in the marketing industry, in the marketing sector. So, as you can see here, Adcore's market cap stands at 7 million Canadian only. However, since this company has about 4.7 million Canadian in net cash, that means that Adcore's enterprise value stands at only 2 million, so almost zero. Meanwhile, Adcore is delivering 23.3 million Canadian in revenue, okay? Which means that Adcore is trading at an enterprise value to sales of only 0.1 times. So Adcore is trading at a really depressed valuation. Now, if Adcore's enterprise value stands at 2.3 million, at the same time, this company is also showing 1.4 million Canadian in operating cash flow, which in other words means that Adcore is trading at an enterprise value to operating cash flow of only 1.6 times. So again, a very low multiple. Now let's compare that to the multiples of other companies in the same sector, right? So here we have Illumin Holdings, which is also a position of mine that I continue to hold. However, it's true that I haven't looked at this company for some months now. So here we have Adcore, Illumin, Fluent, Perion, ZoomD, Magnite, and PubMatic. And as we can see here, the average enterprise value to sales multiple for these companies stands at 0.9 times, which is very low. However, Adcore's enterprise value to sales is even lower than that, much lower than that, as you can see, at only 0.1 times. Moreover, the enterprise value to operating cash flow multiple, the average for the sector, stands at 4.9, at 5 times, as you can see. Adcore's multiple, however, stands at only 1.6 times. So again, Adcore is trading at a much lower valuation than its peers. It's true that the average gross margin for these companies today stands at 44%, while Adcore's gross margin stands at 40.4%. However, I don't think that justifies Adcore being traded at such a discount to its peers. Besides, as we've discussed, Adcore's gross margin is probably going to increase over the coming years, since this company has been investing in a technology division, which consists of their apps. So Adcore has 9 apps, with Media Blast being the main product, the main app. The key thing to understand, though, in Adcore's investment thesis is that, you see, Adcore is a service-based company, is mainly a service-based company. They are a marketing agency. And because of that, they are showing today this 40% gross margin here. However, as I said, they've been investing in a new division, in a technology division. And these apps have a much higher margin when compared to the service division. So these apps have a gross margin of more than 60%. And from what I understood, this technology division, though it still represents today a very small part of the company's total revenue, but from what I understood, this technology division could become like 50% of the business, maybe even more. Now, if that happened, Adcore's gross margin would probably go above 50%. Maybe we could see this margin at 55, 60%, who knows? The point I'm trying to make here is this. Adcore's business is going through a transition, and if this company's gross margin stands at only 40% today, which is below the sector's average, in the long run, Adcore could actually deliver a much better gross margin than most of its competitors, which means that Adcore would actually deserve to trade at a premium. Now, to close this part here, two more things. Okay, so first, Adcore is posting operating losses. As you can see here, Adcore's operating margin over the last 12 months stands at negative 1.8%, which is inferior to the sector's average of 2%, right? However, if Adcore's gross margin expands, and if this company continues to grow, we could see a positive number here. Okay, so please keep that in mind. And lastly, it's important to note that Adcore has a very clean balance sheet with a negative net debt, as you can see here. However, a lot of these companies are in the same situation, are in the same position. So what do we have here? Well, in my opinion, we have a totally fine business here that is trading at a very considerable discount when compared to its peers. Now let's come here to this part here, right? Let's try to get a sense of where this stock could go. So as we've seen, Adcore is trading at an enterprise value to sales of only 0.1 times, right? Now, would you say it would be too aggressive to expect this company, this stock, to trade at an enterprise value to sales multiple of 0.5 times? Well, I don't think that would be too aggressive, especially if this company delivers, especially if the technology division continues to grow. Now, in this case, the projected share price would be 27 Canadian, which would represent an upside of 133.6%. So even considering such a low multiple, we already have a good upside here. Now let's experiment with that a little bit, okay? So, as we've seen, the sector's average, the average for the enterprise value to sales multiple of the sector, as we can see here, stands at 0.9 times. So let's experiment here with a multiple of 0.9 times, which is the average for the advertising sector. Now, considering 0.9 times, we have a potential upside here of 266%. However, if on one hand, Adcore is trading at very low multiples when compared to its peers, on the other hand, the advertising sector as a whole is trading at very depressed levels. So for example, here we have the historical chart of the enterprise value to sales multiple of those companies. And as you can see here, we are indeed trading at historically low levels. So for instance, while today Magnite is trading at an enterprise value to sales multiple of 3.2 times, back in 2021, the same stock was trading at a multiple of 31.8 times. Same thing, for example, for PubMatic, which was trading back then at an enterprise value to sales multiple of 16 times, while today the same company is trading at less than 1 times. Adcore, for instance, according to Seeking Alpha, is trading at a multiple of 0.09 times, while in 2021, Adcore was trading at 4.7 times. So I think it's pretty evident that we're trading today at depressed levels. We've actually been trading at quite depressed levels for some time, right? Now, I'm not saying that we'll come back to this market scenario. I'm not saying that Magnite is going to trade at a multiple of almost 32 times next year, right? Or in 2030. I'm not saying that. I'm just saying that maybe we shouldn't use this multiple here as our reference, because the sector as a whole is trading at very depressed levels. So the market can eventually turn. For example, interest rates could go down, and then, well, who knows, maybe the market could start assigning higher multiples to this sector, to the advertising sector. So who knows? Maybe we could see the average enterprise value to sales multiple of this sector at, for example, 3 times. So with that in mind, where could the stock go if this company started trading at a multiple of, let's say, 2.5 times? So as we can see here, in this case, Adcore stock could go beyond $1, which would present us with a return of only 800%. So yeah, I think Adcore stock is very cheap, and that's why it is one of my positions. That's why I'm long. Well, that's it for today. That was my point. Adcore, when compared to its peers, is a steal, is a very cheap company, is a very cheap asset, and well, you've seen the kind of return we could eventually have here, right? And let's always remember, let's always recall that nothing in this video is investment advice, okay? And with that said, bye-bye, and see you next time.